Item 2. Management's discussion and analysis of financial condition and results of operations. Sadot Group Inc. is our parent company and is headquartered in Burleson, Texas. During the 3 months ended March 31st, 2026, we reported zero commodity sales revenue compared to $132.2 million in the prior year period. This reflects the significant streamlining of our operations, including the closure of certain international offices and the completion of the sale of our Sadot Food Services segment on December 4th, 2025. As of March 31st, 2026, Sadot Group consisted of one distinct operating unit and one discontinued operation. Our revenues have historically been derived from commodity sales. Revenues from commodity sales have declined substantially since Q2 2025. We generated no commodity sales revenue in the first quarter of 2026 as we continue to evaluate and streamline our agri-food operations following the divestiture of our food services business and the adverse judgment regarding our Zambia farm operations. The business has experienced significant trading difficulties around capital to support new trades, disputes on settlement of existing trades, and a number of legal disputes on historic trades. Following the financial performance during the third quarter of 2025, management of the company began evaluating alternative business lines to address this situation. All options are being assessed. The management continues to focus on monetizing the current assets of Sadot Agri-Foods as efficiently as possible. It should be highlighted that the risk of future impairments on current assets is a possibility going forward. Impairments on assets of the trading business cannot be excluded in the near future or in the long run. For the periods ended March 31st, 2026 and 2025, $0.4 million and $1.4 million, respectively, are recorded as stock-based expenses in the accompanying unaudited condensed consolidated statements of operations and other comprehensive loss-income. Net loss attributable to non-controlling interests was nil and $0.1 million for the periods ended March 31st, 2026 and 2025, respectively. During the year ended December 31st, 2023, the company created a joint venture in Zambia in which the company has a 70% interest and the third-party equity ownership has a 30% non-controlling interest. As described above, following the December 11th, 2025 judgment by the High Court for Zambia, the company lost possession, control, and ownership of the underlying farmland assets, which have been fully impaired. However, the company retains a controlling interest in the Zambian entity and therefore continues to consolidate the entity. The company is appealing the judgment. Our gross loss profit totaled nil for the 3 months ended March 31st, 2026, compared to $6.0 million teamless abatement for the 3 months ended March 31st, 2025. The $6.0 million decrease is primarily attributed to a decrease in commodity sales, partially offset by a decrease in cost of goods sold. We generated commodity sales of nil for the 3 months ended March 31st, 2026, compared to $132.2 million for the 3 months ended March 31st, 2025. This represented a decrease of $132.2 million. This decrease is due to Sadot Agri-Foods being unable to enter into additional trades because of lack of working capital. Cost of goods sold for the 3 months ended March 31st, 2026 totaled nil compared to $126.2 million for the 3 months ended March 31st, 2025. The $126.2 million or 100.0% change is a direct result of the decrease in sales. Depreciation and amortization expenses for the 3 months ended March 31st, 2026 totaled nil compared to $27.0 thousand for the 3 months ended March 31st, 2025. The $27.0 thousand decrease is attributed to farm-related assets being fully depreciated in 2024 and the loss of the corporate office lease and furniture in Burleson. Stock-based expenses for the 3 months ended March 31st, 2026 totaled $0.4 million compared to $1.4 million for the 3 months ended March 31st, 2025. The decrease in stock-based expenses is primarily the result of the termination of the service agreement with Agia entered in November 2025. Sales, general and administrative expenses for the 3 months ended March 31st, 2026 totaled $2.2 million compared to $3.1 million for the 3 months ended March 31st, 2025. The $1.0 million decrease was primarily attributable to lower personnel-related costs resulting from a reduced staff count, as well as reduced operating and consulting expenses due to Sadot Agri-Foods being unable to enter into additional trades because of limited working capital availability. Other income for the 3 months ended March 31st, 2026 totaled $2.3 million expense compared to 3 months around $0.8 million expense for the 3 months ended March 31st, 2025. The other income was primarily attributable to the recognition of impairment of assets of $0.1 million, loss on litigation of $0.1 million, loss on debt extinguishment of $0.3 million, all of which were not present in the prior year, partially offset by a $0.3 million increase in interest expense net and $0.8 million decrease in change in fair value of stock-based compensation due to termination of agreement with Agia. As of March 31st, 2026, we had a working capital deficit of $57.8 million, an increase of $3.0 million from $54.8 million at December 31st, 2025, and cash of $0.68 million. Current liabilities significantly exceed current assets, driven primarily by $49.0 million in accounts payable and accrued expenses and $11.1 million in notes payable, net of discount. Substantially all of our outstanding debt obligations matured on December 31st, 2025, and remain unpaid, placing us in default. These defaults, together with the working capital deficit, raise substantial doubt about our ability to continue as a going concern within 1 year after the date these financial statements are issued. On May 5th, 2026, we received a notice from NASDAQ indicating that we no longer satisfy the minimum shareholders' equity requirement under NASDAQ Listing Rule 5550B1. We intend to submit a compliance plan within the required 45-day period and are evaluating strategic options to regain compliance. At March 31st, 2026, current ratio, which equals total current assets divided by total current liabilities, was 0.04, a decrease of 0.01 compared to current ratio of 0.05 at December 31st, 2025. At March 31st, 2026, working capital deficit, which equals total current assets less total current liabilities, was $57.8 million, an increase of $3.0 million compared to working capital deficit of $54.8 million at December 31st, 2025. The decrease in current ratio and working capital was primarily due to an increase in accounts payable, a decrease in net accounts receivable due to large allowances, partially offset by a decrease in other current asset and an increase in other current liabilities. While the company maintains a base of current assets, including inventories and receivables, the timing and certainty of converting these assets into cash has presented operational challenges and led the business to increase borrowing to cover collection delays. During the 3 months ended March 31st, 2026, the company increased its net borrowing by $0.9 million. The company is currently experiencing delays in converting receivables into cash, which has impacted the timing of available liquidity. Management continues to actively manage collections, review credit facilities, and negotiate repayment arrangements with certain creditors to support liquidity requirements. The September 23, 2025 Helena Purchase Agreement provides potential access to up to $10 million but carries material cash obligations. $100,000 liquidated damages per 30-day period if the $2 million threshold amount is not met within 6 months of registration effectiveness, plus 2.0% monthly penalties for registration delays. These cash payments, combined with the company's negative working capital, showing $6,982,000 as of December 31st, 2025, and debt maturities, increase liquidity pressure. The registration statement was initially filed but subsequently withdrawn. The original filing deadline was October 8th, with the Form S1 ultimately filed on November 14th, and an effectiveness deadline of December 23. As a result of not meeting the required timelines, a penalty equal to 2% of the commitment amount was incurred, payable on the date of the triggering event and continuing on a monthly basis thereafter. As of March 31st, 2026, the company has accrued approximately $1.2 million related to these penalties, which is included in accrued expenses. On November 20th, 2025, the company entered into a settlement agreement with Agia LLC FZ that requires a cash payment of $75,000 and the issuance of 1,050,000 shares of common stock. The company has issued 257,000 shares to date, with the remaining 793,000 shares subject to shareholder approval under NASDAQ Rule 5635D. As of December 31st, 2025, the company has accrued a liability for the remaining 793,000 shares within accrued expenses. The settlement also resulted in the cancellation of outstanding promissory notes previously issued to Agia. From a liquidity perspective, the settlement required a modest cash outflow of $75,000, with no additional contractual cash obligations, and therefore does not represent a significant ongoing use of cash resources. However, the settlement impacts capital resources by reducing outstanding debt obligations through the cancellation of the promissory notes and increasing reliance on equity-based financing. The issuance of the remaining shares will result in dilution to existing shareholders and may impact the company's ability to raise additional equity capital. Subsequent to March 31st, 2026, the company received shareholder approval for the issuance of the remaining 793,000 shares, satisfying the approval requirement under NASDAQ Rule 5635D. For the 3 months ended March 31st, 2026, net cash used in operating activities from continuing operation was $0.8 million compared to $3.0 million provided by operating activities for the 3 months ended March 31st, 2025. Net cash used in operating activities from discontinued operations was nil, and net cash provided by operating activities from discontinued operations was $8,000, respectively, for the 3 months ended March 31st, 2026 and 2025. Our net cash used for the 3 months ended March 31st, 2026 was primarily attributable to our net loss of $4.9 million, adjusted for net non-cash income in the aggregate amount of $0.8 million and $3.3 million of net cash used by changes in the levels of operating assets and liabilities. Our net cash provided for the 3 months ended March 31st, 2025 was primarily attributable to our net income of $0.8 million, adjusted for net non-cash income in the aggregate amount of $19.8 million and $23.6 million of net cash used in changes in the levels of operating assets and liabilities. For the 3 months ended March 31st, 2026, net cash provided by financing activities from continuing operations was $0.8 million, consisting of proceeds from notes payable of $1.0 million, partially offset by repayments of various other notes payable of $0.2 million. Net cash used in financing activities from discontinued operations was nil and $20,000, respectively, for the 3 months ended March 31st, 2026 and 2025. For the 3 months ended March 31st, 2025, net cash used in financing activities was $3.1 million, consisting of repayments of various other notes payable of $1.5 million, partially offset by $4.6 million of proceeds from notes payable. There is a degree of seasonality in the growing cycles, procurement, and transportation of crops. The farming industry historically experiences seasonal fluctuations in revenues and net income. Typically, the company has lower sales and net income during the non-harvest seasons and higher sales and net income during the harvest season, and as such, must have sufficient working capital to fund its operations at a reduced level. Failure to generate or obtain sufficient working capital during the winter may have a material adverse effect on the company. Our company has added and will continue to add additional internal control procedures, additional resources, and software to increase the internal control aspects of the company as we integrate our Sadot subsidiary into the overall business. However, these changes have not yet fully remediated the material weakness identified above. After evaluating the effectiveness of our disclosure controls and procedures, as defined in Exchange Act Rules 13A 15 E and 15 15 E, our CEO and CFO have concluded that these disclosure controls and procedures were not effective as of March 31st, 2026. The following material weakness was identified as of December 31st, 2025, and continues to exist as of March 31st, 2026. We identified a material weakness arising from insufficient staffing and limited financial and accounting resources. This resource constraint resulted in inadequate segregation of duties, insufficient review and oversight of complex accounting matters, and challenges in the timely preparation and review of financial information.